on East Mountain Time anyway, on February 19th. And I'm Tim Quast with Market Structure Edge, and welcome to the live discussion. Good to see everybody. Okay, as I was saying, this is what I do every day. Let me get rid of that. I go to broad sentiments. First thing, I always think broad sentiment, context, divergences. So I want to know where we are. And I'm going to come to this next. So I will highlight where we are. So see the green part of the graph. If you haven't seen this before, what we call demand or market structure sentiment is an algorithm, and it meters trade executions in the components of the S&P 500. So it's around 504 currently. It's whatever it is. We're going to meter that. We license that data from S&P Global. So the algorithm is that's what we're doing. We're looking at how orders are handled in the marketplace. We normalize to a 10-point scale so that we can see if money is coming or going. Doesn't necessarily mean, the market's going to change direction, but it often does. When sentiment tops, there's a greater probability of immediately ahead in 5 days or so, things not going so well. And this has happened pretty consistently. As I said, I'm going to come back to that because there's a key point. But I want to know where we are, and it will influence what I do. Supply, again, is short volume, not short interest. Short interest is a 1974 metric that is largely useless in a Reg SHO Rule 201 market where short locate rules don't apply if you're a market maker engaged in bona fide market making. All that means in English is that if you're a broker dealer making a bid and an offer in stocks, your principal job is to fill the order, even if there's no underlying buyer or seller. So you will have to mark that trade short. That's what we're measuring. So short volume peaked right here early January at about 54% and is currently at 50.5% and starting to trend back up. We'll take a longer look at this too, but that's number one. I'm always going to look to see where are we, because it will influence what I do. And that goes to the next thing. If sentiment has bottomed and is beginning to climb, I will go immediately to daily trading ideas. I mean, why not? If you can capture part of volatility in a stock like LITE with volatility of 9% and a high probability in the next 1 to 5 days getting at least 2% of that, it's a pretty good thing to do. But I always want to know, well, how many are there? And so today there are 20 right there in the momentum portfolio. In the low volatility portfolio, and I got that wrong. So I forget who it was. It was Anesh, I think it was you, if you're here, sent me a note and said, you got the ticker wrong. I did. Sorry about that. It's AEG is the only low volatility trade, 79% probability historically. There's no, past performance is no guarantee. It's just we calculated a probability that you could get 1%. You say, well, why would I be concerned about 1%? Because if you can repeat it, it's a great way to produce returns. But it's interesting. There is one in low volatility, and that's not a surprise. Then I go back to the dashboard, and I want to look at several things. I like to keep a mega caps portfolio. So you can do this too. It has one criteria. It is market cap equal to mega cap. It's that simple. And let's see here. How do I get to it again? I'm going to have to go back out. I forget exactly how you do that. Anyway, so I will look at this because I want to look at the demand supply in it because it's 75% of all market cap in these, whatever it is, call 135 stocks. Yeah, 135 of them. And we've been as low as 105, which occurred like April 8th of last year, and as high as, I believe, 138, and that was just recently. So no matter what, the market continues to be very dependent on large caps. They're liquid. You can download this data, by the way. You can go over here and export it to Excel, and then you can check the volatility. It's a great way to say, well, what is the volatility of the biggest components of the market? And it's an effective way to see that. So I always check that portfolio, and it might just be that all of this doesn't take me long at all. I want to look at the demand supply balance. So it's fine. I mean, there's nothing wrong at 6.1, just very similar to the 6.3 that you see in the broad market. If you looked at it from a trend standpoint, that it's generally favorable. The supply right now in the last couple of days, there's no divergence. They're the same, right? So it makes it difficult for the market to rise. Then I like to look at big tech. Where is it? Well, it's diverging again, but the demand is very weak. I mean, if demand is below 5 in big tech, it's going to be hard for the market to post gains. Then I like to look at the sectors. Communication services, look, how is it? Well, it's fine. You could say it's bottomed and started to trend back up, but you look at the supply side. I mean, it's 50 some percent short. That's not great. Consumer discretionary has started to trend down, pretty high short volume. Consumer staples, where there's been a lot of, Josh Brown calls it the halo trade, hard assets, low obsolescence. Maybe that's a good way to describe it. I don't know. Keep in mind, the market is principally run on models and priced by machines. It's not thinking human beings that are making these decisions. I think that's where risk models will tell large institutional asset allocators to go. But consumer staples, I'd look at that and say, well, it's not great. The gains in it are probably done. I like to look at crypto. Is crypto okay? Yeah, but it's not back to 5. And you can see that in Bitcoin. Dow Jones, it's just interesting to see. Supply is rising, demand is falling. It's above 5. There's nothing wrong with it, but you can't look at that and say, well, that's going to power higher. It could change. Energy, it's just been awesome, and it remains so. Look at that. It's a 7.7 for 124 stocks. The supply side is pretty high. And there's, it's not diverging. You would say that's converging, but there is really strong demand yet in energy. There's no question about that. So I do that all the way through. Financials, above 5. But again, I wouldn't buy a declining demand line and a high supply line that's at 53%. Gold looks pretty good again. Here was the time. If gold stocks get to 1, probably a good time to buy them, right? Or gold. It's just a great way to be able to see. You could see everything this way. What all the money's doing. Healthcare. Demand's fine, but it's not great, and supply is rising. Again, I wouldn't say healthcare is a great place to be. Industrials have been awesome. I think they're up, call it 20%, 22% this year. But again, I'd look at that and say, very strong demand, but it's peaked. Supply is pretty high. Tech looks okay. It had a period of weakness here, a lot of short covering, but now short volume is high. Demand is fine and rising a little, and that's crucial. It would say that generally speaking, the market is probably fine. It's very dependent on tech. But is it great? Well, I don't like when demand and supply rise at the same rate. They basically cancel each other out. It's like adding 1 and subtracting 1. You get back to where you were. Large cap passive. This is just an interesting way, and I know there's a disconnect here. I know it, and I told the engineers about it. It has to do with measurement points. I'm not even going to explain it, but I like to look at money where passive models are going. And so the way that you do this, if you were setting up a portfolio, is you create a dynamic portfolio where the criteria are as follows. Key behavior, passive. That's the key. 3 standard deviations in demand and supply. I exclude small caps and mid caps because I just want to see large caps. Why? Because that's where 90% of ETFs are. They're in large caps. 70%, more than that now, more than 70% of allocated assets in, like diversified models, like you're running a 60-40 portfolio and 60% is in stocks. Most of that is going to be in large cap blend, meaning it'll be large cap growth and large cap value. And so it's a great way to see what's happening in the market. I can't remember how to go back. That's not helpful. But I'm doing all this in just a couple of minutes. I will scroll through and look at all those 3 things all the way to utilities. I mean, you can get there fairly quickly, go through all the sectors, and this way you can see everything that's occurring in the market. In fact, here's the total market. And by the way, this 2,825 stocks, we're missing a few, but what we're doing is, this is NMS stocks that aren't penny stocks, generally speaking. I mean, there are some in there. But it tells you that is almost all, 99.9 8% of market cap is there. So the utilities have been very good, and you can see the nice uptrend in demand. And while supply is fairly high, it's not rising. That's a pretty good place to be, and they have performed well. So that's what you can do every day, and you will know. You'll know more than just about anyone who is looking at the market, and it gives you a very good idea of where things are going. Okay, so now I want to go back and point something out. This is number 2, second item to cover. By the way, I am right now, at this moment, I'm not trading daily trading ideas, and I'm not in the model portfolio only because the market is at the red line. When it is, I will tend to trade volatility. So at each of these points where demand was declining and we were hitting options expirations, traded volatility. I started, and I have steadily increased that. I mean, I have a big volatility play because it's produced very good. It's up 30%. I mean, you look at the VIX. I think the VIX is a consequence. It doesn't tell you what's going to happen. This will tell you where the probabilities are. But here's the thing that I wanted to note. Let's expand out to 6 months. The big change in the market occurred about, when Bitcoin flash crashed. I don't know which is the horse and which is the cart, but you can see it here. It was when we had this period where demand just flattened out. And then you come down here, and this is what gave us the gains. Declining supply supported the market, but demand stalled about in here. You could say right into the end of the third quarter, calendar third quarter. And then we had that, wow, we got hit. And since then, we have had multiple snapbacks like that. So a divot and the market recovered. A divot, and I didn't make money on that. I had a big volatility bet, and it was up like $50,000, and I gave it all back. So it's because it snapped back. And then we did it again, another snapback at options expirations, and then we did it again. Then we had this weird thing, and then here we are at options expirations, and it didn't snap back. It's the first time since this change where that has not happened. Now, I don't know what's going to happen next, but anytime that you have a change in the general central tendency, it should get our attention. And I would say that generally, the trend on the supply side now, it's certainly not bottoming like it did. I mean, this is fairly low. It's it's over 50%. You can see that everywhere. That's a function of ETFs. There are so many products dependent on this shrinking set of underlying assets called large caps. There are only so many of them, and so that will necessarily increase the dependency of the market on created stock, almost like credit. The market everybody uses credit, but I would note this as if this does not snap back. I've said, I think that the market it is at significant, of course, I've been wrong before. I thought this was going to be it, and it didn't happen. I'm often early in those situations where I think, okay, the trend has changed. So with that caveat, I can look at this and say, I think that the market is at significant risk of breaking down. Now, it may not. I don't know. I have a natural cynicism about these conditions because I know so much about the mechanics of the market and how fragile they are, how thin the layer of liquidity is. So naturally, I'm going to see those things. Okay, the third thing. So we can discuss that, and just interrupt me if you have questions, because I don't, I may or may not see them. Okay, let me check. Bear with me. Okay. Yes, Joe. Okay, so Joe says, so you buy UVXY when it gets above the red line, particularly at options expirations because of what has been occurring. After October, I've been doing that. Yeah, and twice to UVIX or UVXY, and those are volatility plays. So they give you leveraged. I'm not recommending that. I mean, It's a risky endeavor. For me, my trading account is immaterial. It is not, I'm not risking anything that has a consequence for me. But you should, with that, with keeping that in mind, it is that knowing that this has repeated and repeated, it has been a very effective way to play these short-term inflection points. So we can talk more about that. And the last thing here before we get to what's next is volatility. I mean, clearly the market is much more volatile. And you would say, well, how would I track that? Well, we have discussed it internally. I would really like to have the 1 day, 5, 20, 50, 200 day S&P 500 volatility figures. Are those the best? I don't know if they are, but we track those. So long, I've always said there's the 1, 2, 3 rule. SPY moves that's another thing I always check, by the way. I always look up SPY because the market is so dependent on derivatives that the SPY becomes a way to see what people are doing with derivatives. And it's not going to have demand fluctuations like individual securities. It's very flexible. ETF shares are constantly created and redeemed. Was it yesterday? Yesterday, yeah. I was talking with one of the guys at the DTCC, good friend of mine. They're the people who know what's in the creation and redemption baskets. Everything runs through the DTCC. And so we were talking about this, but the way that this instrument works is it's most of the time going to reflect value and growth, large cap value and growth. If you added them all together, what would it be? 5. It's going to spend most of its time at 5. So the changes in price of SPY are heavily dependent on supply. If supply declines, price rises. If supply rises, price declines. And it happens in very short increments, but it helps you to see where we are. I still think this is data error driven. I don't believe this actually happened. I had our engineers go back and revisit it because we had an issue with data from an exchange, and it was erroneous. And it rippled through, and we corrected everything we could. We've recalculated, and it keeps coming to this. I don't believe it's right. I think it stayed at 5. But at some point, that's going to happen. So it's a key thing to watch. But anyway, from a volatility standpoint, this moves 1%. Broad market tends to move 2. Momentum is 3. That's why for daily trading ideas, we look for momentum because we're going to capture part of volatility. Well, the whole market right now is running at about 3.7%. Actually, the whole market is 5%, but the S&P 500 has 3.7%-ish daily volatility, the spread between the highest and lowest average prices. That's astonishing, and it's very difficult for people who are trying to keep a basket of stocks aligned with ETFs or the options. And now we're going to launch. Somebody sent me a note about that. Single stock futures are going to be back on over 50 of the largest stocks. So we will once again have true quad witching every quarter, where there will be the expiration of index and stock options and futures. And so, we keep leveraging the market and extending it into derivatives, and it makes it difficult to know the condition of everything. But SPY will give us a clue into that. So volatility is key. That's the core to what we trade. Okay, questions, comments, observations. I'll wrap with what's ahead. But let me get to questions here. Okay, Brad. So Brad says, I know you have low confidence in things like Elliott waves, Gann cycles, Bollinger Bands, the Chaikin flows, all that kind of stuff. Yes. But they're showing that, a warning about a breakdown in the market. Okay. Well, I agree we are closer. A thought that I started to form, but I didn't finish is how long it has been. And by the way, you can track this yourself. Since we had a breakdown below the green line, which is both the end of a cycle and an entry point. To this point, if it's why I haven't put more, I haven't increased I've decreased exposure to the broad market, because if you expand to, let's do 1 year, well, it's not year to date, 1 year. And then you can download that data, and then you can go calculate how long it's been since this. So it's been, I think today is 209 days. So that's a new record, the all-time record previously in the data set, realizing that the data set is only back to 2017, because that's when the data that we could use to create a large-scale model became available. I mean, just randomly. I mean, we consumed data and we found these products. So the previous record was, as I recall, it was like right in here. So this period, yeah, that's it. This was 208 days. And then we had a bear market. So as we have approached that, I thought, well, at some point, are we going to set a new, well, now we have. So AI, or whatever we want to call it, as the catalyst, has created the longest period without a breakdown below that green line. And, particularly the big ones are, 3. If you break down to 3, it is clearly a change in the cycle. Has always been true. And so do I think that that's going to happen? Well, I mean, the likelihood rises the longer it goes, right? The only thing is you can't predict when it's going to happen. Could be maybe we go 300 days. I don't know. But I know it's as long as we've ever seen. And that when the cycle ends, it's probably going to be rough. And particularly because it's been so long. Okay, with somebody asking a question, I'll go back and see if I've missed anything here. So Brad, to conclude, yes. There are a lot of signals that could get you there, right? We're not geniuses by any stretch. It's just, interesting to look at those things, and you can draw some pretty good conclusions about it, right? Okay, so that gets us to the last thing, which is what's next, and I've kind of touched on it. Again, I just check the data every day. What do I think is going to happen here? Well, I think there'll be volatility. I think that's not over. Once we get past maybe Tuesday, then we'll see. The opportunity may have come and gone again. We'll find out. I do think it's very significant that we have not had a snapback, as we have all the way back, as I said, to September or October. But the next thing we look for is a bottoming in the cycle, and what does the supply side do? And during periods like this, I am not going to be, heavily committed to positions in equities. It doesn't mean that the market's going to fall apart, but why would you don't want to put money in at the top. You want to have an entry point where, at least here, like, if the demand bottomed here at whatever it is, 5.3, well, at least that it's not falling, and that you can probably catch some gains, and then you get to options expirations and it's volatile. And now it's, the cycle comes down to here. Maybe here you could enter again, but it's a difficult play. It's been challenging, but why would you do it? Because demand bottomed and supply fell. I mean, those things will repeat over and over, and they give you a better confidence level of what may come next. So I'm looking at that and saying, well, now the next cycle will be something of this kind of order, right? You would expect supply to rise and demand to fall, and for volatility to persist at least for a number of days. Why Tuesday? It's Counterparty Tuesday. New options trade Monday. Will we have the same demand for those in a volatile environment? I would wager not, but I don't know. And then the banks will square the books. And when you have a lot of volatility, somebody's going to have to pay more than they had planned on. And that tends to lead to asset sales. If a bank helped big institutions transfer risk for a price, and then they square the books and the bank has to pay them more, let's say, then the bank will sell an offsetting asset and the market takes a hit. So those things are part of the cadence and calendar of the market that you have to be aware of. So that's what I think. Questions, comments, observations? Nothing? By the way, I've said before that when we ended our interactive brokers relationship, and I'm working on another. So during this period, our audience is going to be smaller because I'm not doing anything to, get the word out. But if this thing we're working on takes root, it'll be a good door for us. So we'll see. I'll keep you posted. Anything develops. Okay. Candace. Let's see. How do you think AI has contributed to this longest period without a breakdown below 4? Well, what I mean by that is, so you could go back to the pandemic, and the pandemic gave us the longest cycle. What was the catalyst there? Money. I mean, the central banks infused the planet with $16 trillion. It says to go somewhere. And it went into risk assets. It's timelessly true that this is what will happen. AI is like that in the sense that immense amounts of money have been thrown at it. And by my way of thinking, no matter how much promise or potential it might have, um, it's overdone, but it creates a bubble. So that I think that extends the market. That if money gets pumped into uh, the technology and then into the equities that are associated with that technology, it creates a catalyst, and then you find out how big it is by how long it lasts. And I would say it's enormous, right? Is it bigger than what the central banks did? Well, no, but the cycle's longer. It's just fascinating to me. Um, can you use David? Good to see you. Can you can you use the data to identify defensive stocks that could behave better? Yes, absolutely. Right? You could set up. I have a portfolio, in fact, that I call the safety portfolio, and it's just this is a static portfolio, meaning I put the tickers in, and it's not perfect, but it's a good little read, and it's going to be our our portfolios find them. Our model focused momentum portfolio has owned this stuff. Um, it may, I don't know, it's held AstraZeneca, J&J, KO, because it's going to find where money goes. And you can see it in the demand, from 5 to 10 here. Supply is generally lower than the market. Only Novartis is fairly high. Look at volatility, much lower than the market. So that tells you that's where the money's going, right? Josh Brown could call it halo stocks. I would say the money will find its way into lower volatility, stable value style stocks that are at 5. But then those things too much money will chase those goods, and they begin to behave like momentum stocks. And that will help us know. And you could use your dashboard to look at the sectors. You could create portfolio. You could say, well, I'll create a value portfolio using a factor model and find your value stocks. I just say find 5s, right? You could go in here and create a portfolio of stocks that are at 5 that are large caps and with volatility of less than 2.5%. And it will probably show you where the money's going. That's a good question, David. Appreciate that. Okay. Anything else? If not, I will let you go.